Debt bomb is a financial institution which defaults on its obligations that causes disruptions on the financial system of the institution's country. This can occur when the consumer spending is heavily based on debt. There are over 7,000 universities in the US, all of which are quite costly and prices are still skyrocketing. The average tuition price is $40,000 per year and over. According to Forbes, public universities' tuition prices are increasing because the state is cutting education spending, and for private universities, budgets are swelling as they spend more on research and campus amenities to attract the world's best and brightest. From 1970 to 2013, tuition costs increased by 275%. However, since higher education is considered as a necessity, its demand is inelastic. This means that an increase in tuition price will insignificantly reduce the quantity demanded. In fact, demand for higher education is still on the rise, specifically 5.2 million
Since
the
most
year
families can afford
2000.
it, they ask for student loans. Student loans aims to give students reliable access to funds that will help them get through college by deferring some of its cost until they have an income. However, during periods of inflation, banks increase interest lending. That has caused student debt to rise from 364 billion in 2004 to 1.2 trillion 10 years later, according to New York Fed data. Therefore, the government has been experiencing massive debt from giving out too many student loans. Consequently, the US government might be experiencing what we call a debt bomb, but is
Higher education should increase our choices. Many economists agree that education is directly correlated with economic growth. It improves personal life, makes us aware of what we know and what we can do. Education positive externality of consumption, its social benefit exceed the private benefits. So, MSB will be greater than MPB. Now, let's examine the effects of the debt situation on this externality. You are a student hoping to graduate and enter the real world, but now you're paying more to cover the costs of college, like rising tuition and increase in significant loans. According to National Education Department, currently about 40 million Americans owe 1.2 trillion in student loan debt. The country approach towards education has changed. Higher education should be the tool for upward mobility. But now that is being called into question. It is true that in the short term, education loans provide students with financial relief and the opportunity to get a degree that wouldn't have been possible otherwise. But in the long term, you will have to face the consequences. You, like many other students, will take one or more loans out. You'll pay interest in some of them while at school, like 4 to 6%, and you'll have to repay the rest when you graduate. That is when you run into trouble. After graduation's grace period, you have to start making monthly student loan repayments. If you have no jobs, like 14% of college graduates, you have no income to pay for that. And even if you find a work, the chances are that in this short period of time, the pay won't be enough to cover all. Hence, you become one of the 30 million US American students strapped with student loan debt. The cost of this situation is that the student makes sacrifices, like maybe you don't buy that new car or you don't eat out every night and you have to purchase inferior goods due to lower income. The biggest sacrifice is the opportunity cost of giving up a dream job with a less glamorous one but necessary to cover this debt repayment. But are you happy? Are you fulfilled? Hence, the loan burden can force students to make career choices that don't fit with their skills and talents.
Now, on a bigger scale, what happens to the general economy? We know that a large proportion of the salaries will go towards loan payments instead of consumer goods, so less money will be circulating in the economy. The economic impact of delayed consumption is predominantly visible in sectors such as home ownership. According to the US Census Bureau, banks are less likely to lend loans to highly indebted graduates. Thus, this will become more challenging to qualify for a mortgage, and explains the situation in which home ownership rate has been decreasing over the last 6 years. Consequently, with less people buying homes and demand for house building going down, the excess supply will put those working in housing construction at risk of unemployment. Home ownership is just one example of how student loan debts can reduce the overall social benefit of the American economy. Young adults have traditionally been major contributors to economic growth, because this is when they significantly bump up their productivity and consumption levels post-graduation and into their 30s and 40s. This should fuel GDP growth, but for those who are dealing with crippling student debts, face the inability to spend to their full capacity. This, along with the fact that 70% of US GDP is made up from their consumption, means that economic growth will be below its potential growth. On top of this, an increasing amount of Americans are forced to delay retirement in order to pay off student loans, and in turn harms the younger generation even more, as they not only struggle to pay off their own student debts, but they will face more difficulty finding jobs, and since they're still being occupied by the older generation, this could potentially deepen the crisis of delayed consumption in the US.
Explain if you cannot take loans for houses because of student debt, or if general consumption is worse off because of student debt, there is a punishment rather than the reward. Hence, the overall choices are reduced. There is a problem. This can be demonstrated through a reduction in MPB, marginal private benefits, which are also directly reduces MSB, hence shown by an inward shift away from the optimum level.
According to economists, the debt bomb is going to explode and nothing can be done about that. However, although repaying the debt is impossible, to defuse it, the Federal Reserve is keeping interest rates very low so they can afford to service the debt. However, this is not happening. Interest rates are going up, inflation is increasing, and so creditors are going to demand a higher premium. So far, there have been no effective solutions despite all the attempts. Although Hillary Clinton believes that part of the solution could be letting students refinance their loans with lower interest rates, making it cheaper to borrow just makes it easier for schools to raise tuition fees. Moreover, a potential solution could be increasing taxes, such as what happens in European countries, where governments keep taxes high in order to make universities cheaper or even free to make them more affordable.